This is Boomer Life on CL 650.
Talking money, 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 money from the OJs in the 1970s on this episode of Boomer Life. It's all about money. It's all about personal debt, and it's all about, well, sorting it all out, getting it fixed up, getting it straightened away. Our guest is Brett Luckin from Abakhan and Associates, trustees in bankruptcy and proposal administrators. Brett, you've been talking a lot about the rules. So,
Right.
and we talked about the distinction, the very, very big difference between a consumer proposal and the classic bankruptcy. Most people expecting to go bankruptcy end up, well, surprisingly not having to,
Right.
and they sort it out. A consumer proposal would be the preferred route, wouldn't it, every time?
It would be the preferred route. I say that mainly just because, if you don't have to go bankrupt, why would you?
What does, on the credit record, what is the impact of a consumer proposal versus a bankruptcy on that mythical credit record?
On the mythical credit record, proposal is marginally better than a bankruptcy.
Okay.
Although I would point out the obvious is that many people who come and see us who have defaulted on repaying of debts and have credit collection agencies calling us.
They don't have much of a credit
They
record
don't
to
have
brag
much of
about
it,
anyway.
No, so really actually filing a bankruptcy or proposal is unlikely to make it much worse.
True.
Right. And in fact, that's a bizarre reality. The bizarre reality is that people will come and see us who are barely making their minimum payments,
Right.
and may well have good credit records as a result.
Because they're making the minimum
Because
payments
they're making
on
them,
time.
but of course they can't afford the debt they have
Right.
whatsoever. But their
Right.
credit rating is very good, and of course the moment then they file a bankruptcy or a proposal, that severely
The whole house of cards comes crashing down.
Yes, but of course
Right.
that's relatively inevitable, because if you don't file a consumer proposal or a bankruptcy and you can't make your repayments, then garnishment collection agencies are the inevitable.
Sure.
Yeah.
What about exemptions? When you file a consumer proposal or a bankruptcy, are there any special conditions that we should know about? Is anybody... Well, tell us about the rules.
Okay, in a bankruptcy, an example will be that, as I mentioned to you, $4,000 in BC, it's $4,000.
Oh, for household effects.
For household effects.
Sure.
Depending on where you live, it can be 9,000 or 12,000 exemption in your home. So, in other words, if there were any money left over once a trustee has calculated what equity is available in your home, you'd get to keep, depending on where you live, up to $12,000. Your RRSPs, as an example, are in fact completely exempt except what you put in there in the last year. So your retirement income will not be marginal unless you, of course, stuffed your RRSP madly.
So RRSPs are
Other than the last
basically
12 months.
But how many people know that, and how many people have the misfortune of exhausting
their RRSPs.
every cent in their
Yes.
savings account, in their RRSP account, in a desperate attempt to address the money behind the eight ball
Well, that's
issue?
exactly it. When you think about it, if people who very many whom have actually lived on their RRSPs by basically just pulling that cash out
Sure.
in order to live on,
Yeah.
have in fact borrowed against themselves. I think I mentioned to you, you're actually really borrowing from who you're going to be 20, 30 years, and you're never going to pay that person back again.
Right.
And when what they could have in fact done was filed a proposal potentially, or maybe even a bankruptcy, and that would not actually have affected their RRSPs at all, and
Wow.
they would have been able to keep that money.
And this is, again, something most of us just don't know.
No. In motor vehicles, you're allowed to keep a motor vehicle up to a value of $5,000. If the car's worth more than that, you may have to pay your trustee something inside a bankruptcy. But very often, in many cases, the bottom line is that your basic assets stay largely untouched, or you can negotiate with your trustee to keep them.
Two other quick areas, if you don't mind: student loans and Revenue Canada or Canada Revenue Agency debt. Tax debt.
Tax debt. What I should point out is there are some special debts, and these special debts do not get resolved inside a bankruptcy or a proposal. One of them is student loans. If you've been a student inside the last 7 years, any loan related to that course of study will not wash away inside a bankruptcy or a proposal. Then, of course, there's things such as secured debt, the obvious ones, like your car and your house. You can't compromise those. The bank is secured to those. Arrears spousal support or child support will not get washed away. It's a special debt, and it will survive your bankruptcy or proposal if your bankruptcy or proposal doesn't pay it out in full. And people who are sole proprietors, in other words, you run your business not through an incorporated entity, but in your own name.
A proprietorship,
A proprietorship.
Right.
And you incur source deduction debt. In other words, you deduct from people's wages, your employees.
Yeah.
You do not give that to Canada Revenue. That is a very special debt, and that kind of debt has an exceptional priority in a bankruptcy or a proposal and has to get paid no matter what.
Ah, okay. So there are a few exceptional categories.
There are a few exceptional categories.
Brett, we've only got a couple of minutes left, and I need your advice, sir. This is Boomer Life. We boomers, well-intentioned, loving human beings that we are surrounded by relatives, younger people in our lives, nieces, nephews, sons, daughters, grandchildren. All of whom, or many of whom, are going to come and try and tap us for a few bucks. Need to buy a house, want to buy a car, want to buy an RV, got a baby coming, need to upgrade the house. When a boomer parent or relative is persuaded by a relative, a younger person in their life, to contribute financially to that younger person's circumstances, what are the practical rules surrounding how we should conduct that loan or gift? Because you, sir, as a trustee, see the other side of what happens when people don't approach it with some kind of sanity and get burned, and sometimes quite badly.
Right. There's two areas. One is joint debt issues. For instance, your son buys a car, your son or daughter buys a motor vehicle. It doesn't earn enough money to be able to get the loan from the bank.
Dad co-signs.
So dad co-signs.
All right.
Okay. So there's those kinds of things. Student loans, potentially like student loans, a line of credit with bank that are not federal or provincial loans, but actually you go to a bank and you get them to loan 20 grand, and then mom and dad co-sign. So you get those kinds of joint debts. Those kinds of things very often will come back and haunt mom and dad when when the student can't repay.
Right.
So I think, and then there's the other kind of debt, which is generally related to items like homes.
Sure.
Mortgages, where what happens is mom and dad who have a very low mortgage or perhaps don't owe any money whatsoever, dip into their own mortgage, pull out money, and loan, and I use that in inverted commas, to the daughter or the son to buy another property.
Inverted commas, by the way, are South African for quotation marks.
Quotation
and
marks.
he's putting things in quotation marks through the entire program. But no, but
I'm using my fingers.
I know,
right.
But a loan.
It's a loan.
It is a loan. If you're giving. See, this is where parents get crossed up. Our precious little daughter is getting married. We're going to give her $100,000 so she and her beau can go buy themselves a home and start a life.
But
now, nothing wrong with that. Nothing wrong with that.
Here's the mistake mom and dad make. First of all, the mistake mom and dad make is that what they do is they don't approach that loan like they would anything else, which is with a lot of trepidation and due diligence.
Right.
You would never loan $170,000, and I use that figure because I know of a couple that did exactly this.
Okay.
You'll never loan $170,000 to just anybody.
True.
Okay, but when you loan it to your daughter, why would you do that without first checking out why you're doing it and how to protect yourself? And in this particular case, and this I think is a case that probably you can extrapolate to many other circumstances, they loaned $170,000 to the daughter who was just about to get married to buy a property. They took no security against the house. They could have registered a mortgage on the home,
right.
which is what they should have done.
Right.
Just had to see a lawyer, pay a couple of $1,000s. You are loaning $170,000 after all.
It's big cash.
It's big cash. And what happened is, of course, the son and daughter. The son went bankrupt. Son and daughter fell apart. The relationship fell apart, and when the son went bankrupt, the trustee now owned the half of the son's house. And the result of that is that
what happens to mom and dad's $170K?
It turned into less than 85.
Oh my!
Overnight. Okay, and keeping in mind
because of the division of assets.
Because of the division of assets, and because the son now being bankrupt, his half of the home now belonged to the trustee.
Oh.
And mom and dad took no. And if mom and dad had taken security, what would have happened is, in fact, the trustee would have had no interest in the property whatsoever.
Right.
And mom and dad would have got their whole $170,000 back.
So the point is, and you know, you can't fault mom and dad for loving their daughter and wanting to see her and succeed. We all want our children to succeed. We all want the best for our children, but we can't be stupid about it. If all you're suggesting is if you're going to conduct a major financial gift, and I put that in quotation marks, a loan or gift of some kind to a young person in your life, imagine that person to be anybody other than him or her, and would you give the same amount of money, no strings attached, to anyone other than that person?
Correct. That's exactly it.
That's the rule, isn't it?
That is the rule, yes. Yeah.
And it's a tough one to follow because there are children.
That's right. But remember that it's your retirement income. You are 65, 70 years old. You have no time to recover if this deal goes bad.
It's always good to have you pop by with your inverted quotation marks and commas and all the rest of it. Our guest,
Thank you, Sterling.
A trustee in bankruptcy, a real good guy, and his phone number, by the way, from anywhere in British Columbia is 1-877-308-8877. All of the information, all 5 offices around British Columbia, and, of course, Brett Luckin's personal contact points and all the good people at Abakhan Associates on the website, Abakhan, ABAKHAN.com. See you next time on Boomer Life.